Thank you for joining us at xm.com. This is the week ahead, and we're definitely in for an exciting week with events not only on the financial front, but also on the political front. And these, of course, events will determine the next market moves. I'm Christina Marujos. With me today is Raf Boyajian, our lead market analyst. Rafi, starting with the United States, there's a lot of speculation whether Trump's tariffs will fuel inflation, and of course, how would that affect Fed policy moving forward. That's why this week's CPI numbers will be particularly scrutinized. What are we likely to see in the data, and how might that affect the dollar?
Yes, Christina, indeed. A lot of question marks about just what the impact of tariffs will be on inflation. So we're seeing a little bit of an impact already when it comes to producer prices. We saw that last time where it kind of dented somewhat rate cut expectations. So therefore, this week, we're not just going to be watching the CPI report very closely, but also the PPI report, which comes out a day earlier on Wednesday. And this will be the last reports before, of course, the all-important September FOMC meeting, where it is pretty much fully priced in that we're going to get a rate cut by the Fed of 25 basis points. This was quite well communicated by Chair Powell in his Jackson Hole speech, where he pointed out that the downside risk to the labor market may now be greater than the upside risk to inflation, which means that, they're worried enough about the labor market to kind of put aside those inflation concerns for the time being and lower interest rates. But of course, even if the September rate cut is a done deal, we really don't know the pace at which the Fed is going to be cutting rates beyond the September meeting. And even so, the more dovish FOMC members like Christopher Waller, he's also said, that's something that they're going to need to discuss before deciding on the pace. But of course, we are going to be getting the dot plot. So even if we get, say, some upside surprises, either or both the CPI and PPI reports, that's probably not going to hugely influence the decision itself, but it might actually be significant for shaping a dot plot that we're going to get on the September 17 decision. So I think, it's going to be quite insightful to see whether or not we are starting to see a bit more of an impact from the higher tariffs, and what the pace at which the Fed will likely cut rates until, maybe not so much this year, but especially in 2026, there's a lot of speculation that the Fed might turn more aggressive, especially, say, for example, if early next year we start to see the inflation impact from higher tariffs start to dissipate. But of course, still a lot of uncertainty about the tariff policy. Yes, we've got a lot of trade deals already, but those trade deals are not set in stone. We're still, getting announcements about sectoral tariffs. And of course, we have still some sticky inflation domestically in the US. For example, services inflation, in fact, has been heading higher in recent months. So that's also something to consider in terms of the market reaction we're likely to see. So even though September cut is not really in doubt, should we get some strong set of numbers, I think we may well see the dollar gaining on the back of it.
And now let's cross into Europe. The European Central Bank meets this week, and investors anticipate no change in policy. So I think the main focus will be on any comments about future policy. However, we've seen the euro struggling a bit lately. Could this fact help it stabilize a bit?
Yes, so I think the ECB meeting, it might turn out to be a bit of a non-event, because I think we're almost certain that the ECB is going to keep rates unchanged at 2%. And they've also been, a lot of policymakers have been signaling that they're probably going to stay on pause. Lagarde hasn't been quite so explicitly signaling a long pause, but should she do so in her press conference, I think we may see the euro come under even more pressure than it has been lately. Um, because I think if you look at market expectations, another 25 basis point rate cut is not fully priced in, and although we've got decent odds of rate cut by the middle of next year, I think those expectations could change depending on which way the inflation data goes. And as we saw for the latest inflation readings, in fact, we had a slight upside surprise, and some policymakers have actually been saying publicly that, the next move might indeed be upwards. But then we've got some other policymakers suggesting that we may see inflation surprise to the downside. So I think it's going to be kind of a tough job for Lagarde to balance the two side of the arguments. So she may refrain from giving too specific signals about future policy and maintain that data-dependent approach. However, she's also probably going to be quizzed in a press conference about the latest spike in Eurozone bond yields. We've seen some volatility in bond markets, and she'll probably have to explain to investors whether she's worried or not about this rise in bond yields, and whether or not that would affect policy decision making.
Well, speaking of yields, it's important to mention that the euro will also take its cues this week from the political front. On Monday, all eyes will be on the French vote for France's budget. So, how could the outcome affect the single currency?
Indeed. So the French budget vote is in fact the main worry, or the main actually the French yields. Question mark about French deficit is really what's kind of driving bond yields higher as far as the eurozone is concerned. French 10 and 30 yields have rallied quite strongly because the France has a very large budget deficit. The current government, which is a minority government, Macron's coalition, it's struggling to pass through major reforms to lower spending. So the French Parliament has to decide on the next budget for 2026, and Prime Minister Bayrou has, set a target of lowering deficit, at least making cuts of up to almost 44 billion euros. But this looks set to fail when the National Assembly votes on it on Monday. And we have to see whether or not it's going to lead to a snap election, or whether if if it fails with just a few votes, maybe there might be a way work through, say, for the government to make some compromises with some of the other parties, and they might still find a way to maybe pass this budget, slightly altered budget. So if it looks like it's not going to lead to a snap election, we might not see huge reaction in the euro, and in fact we might see a further pullback in French government bond yields. Of course, we do have some calm now, thankfully, in the markets, but of course, if it does fail with a large large vote, then I think it's going to be almost certain, and it looks almost certain that's going to be a snap election that could really hurt both French bonds and the euro.
I see. And Rafi, finally, moving out of the FX space, the OPEC Plus alliance meets on Sunday. And until recently, the speculation was that OPEC producers were going to pause their output increases. Now, what's changed on that front? And what could this mean for oil prices?
Yes, so we were really heading into this meeting thinking that OPEC was going to decide to keep output unchanged, because we've been seeing output increases every month since April, when they first started normalizing, supply within the cartel. Now it looks like they are indeed considering, further output increases, which is kind of questionable if you think about where oil prices stand at the moment. They're not doing so greatly. They're kind of approaching, this WTI futures is approaching $60 a barrel, and there's a lot of analysts are predicting about potential supply glut by the end of the year. So why would they be thinking about raising output further? Even the sort of diffuse spikes we saw on the back of geopolitical risks, for example, the Israel-Iran conflict, and fading of hopes, or the threat of fresh sanctions on Russian oil exports by the US. None of those had lasting impact. So we're kind of maybe getting the sense that OPEC is right now more focused on gaining market share rather than keeping prices supported. So if you do get a confirmation that either they're likely to raise output or they do decide to raise output, I think that's going to be quite negative for oil prices, because it's going to confirm in a way that the main goal right now is to increase market share rather than stabilize the market.
Rafi, thanks so much. This was The Week Ahead here at xn.com.